Good morning, everybody. Welcome to Friday. Looking forward, as always, to our discussion today. And as always, since it's Friday, the market is open, and Expiration Friday specifically, there's going to be plenty to talk about. So we'll be diving into it here in just a minute. For those of you who might be new to this live stream and to Rebel Income, just a little bit of introduction about what this live stream is about, and the approach that we like to focus on as income generators. This is good morning, Gib. Welcome, and I'm excited for everybody who's here. Couple of One other note: if you, one of the things that helps this live stream is to see how engaged the people who are in it are. So in the chat area over on the right side of your chat, welcome, Jay. You see some icons there for things like emojis and reactions. If you like something that we're doing, you can throw up a reaction to it. Here, for example, is a heart. Here's a laugh, something like that. Agreement or not. A lot of different things you can do. Anyway, those help to show engagement, and that's something that is useful not just for myself, but for the YouTube algorithm as we're trying to attract people into it. So if you see something you like, always clicking like on the video obviously is useful as well. And also invite people who you think might be interested in this in the subject we're talking about, the stock market, investing, income generation. Oh my gosh, good morning to you, Barry, and celebrating the anniversary of your 25th birthday today. That is awesome. I'm not going to ask how many 25th birthdays you've had, because that's just not nice. I'm just going to assume it's your first. I just had mine last week, so I like the fact, Barry, that our birthdays are literally just 1 week apart. That's awesome. All right, so Rebel Income is Jay Sunday. Oh my gosh, actually, so October 5th is my birthday. Jay, you and I were birthday twins, man. I'm sorry, I got to do one of these for that. That's for you and Barry both. Yeah, October 5th. That's awesome. Okay, that's really exciting. So Rebel Income is an investing system that is built around a few different core concepts. Our objective, our goal, is to generate practical income on a monthly basis, and if we can do it more often than we do. Barry shares a birthday with David Lee Roth. Hey, that's pretty cool. Even better if you actually got to spend your birthday with David Lee Roth, right? Maybe have a little bit of a party. Anyway, the objective here is to generate income on a practical basis, on a practical monthly basis, I should say. We do that by focusing on fundamentally solid companies that pay dividends. That's one part of. Yes, Barry, that would be an interesting chat for sure. We do that by the income portion of what we do is partially by taking in dividends, on these fundamentally strong stocks. You can see on my chart I have 3M Company, and that's one example of a stock that I've followed for some time. I don't have current positions on it at all right now. Just happens to be the one that's on my chart. But the other part of this too is not only being able to bring in dividends on stocks we own, but we use option selling both to generate income and to set up these practical opportunities to own good companies at what we consider to be good values, even deep discounts. So this is a little bit of what I call a contrarian method, because stocks in upward trends like what we see with 3M here, these generally don't fit the bill of what we're going to be usually looking for. We're usually looking for stocks that are at the low end of trading ranges. MOS, it looks like it's starting to break down here. Let me see if I can find something that's a little bit more typical of some things that start to look a little bit more interesting. Here's Pfizer. This is a stock that I've been in for quite some time, but this is an example of a stock that bullish growth-focused investors are going to stay away from, simply because of the fact that it's been in a very long-term downward trend since 2022. On the other hand, the stock has also recovered since April from a low around $21 to its current level, currently falling back off of a peak. But this low relative to historical norms is part of what creates the opportunity to look at a stock like Pfizer from an income generation standpoint. Yeah, Barry, you're Jay, October 5th, Neil deGrasse Tyson. There's another one that would be interesting, chat, right? And Intel today, not talking about rising out of the ashes. Yes, there's big move since September for sure. So the idea here is that when we find these companies that fit the descriptions that I'm talking about, we generate income by selling a put option on them. The put option is both an opportunity to generate income and to set up a potential purchase. And that, excuse me, that purchase comes from the fact that when you sell a put option, when you sell any option, really, you are creating a potential obligation. In the case of selling a put option, you are creating a potential obligation to buy the stock that you sold the put option on at the strike price that you sold. So let's use this week's put sale as an example. This was, I need to scroll back up here, on Nike. This is a stock that I've used a number of times and use this for this week's put sale. This one expires on the 24th. I sold the $68 strike price. So let's take a look at Nike. Again, this is a stock that has been recovering since April, but is currently, change my colors here, currently falling back from this peak a little bit below 80, down to its current price around 68. But if we zoom out here, we see this is another stock that is following a downward trend, kind of like Pfizer, since 2022. So being down in the lower end of these historical ranges is what starts to create the opportunity to look at the company, consider whether it might be a useful stock for the kind of income generating trade we're looking for. By selling the $68 strike price, the stock is hovering right around that level now. I've set up a potential obligation. If the stock drops below 68 before expiration, I can be assigned at 68. That means that the buyer of the put option can exercise their right. I have to, they would then buy the stock at the current price. Say it's at 65, 62, who knows? Whatever the current price of the stock is at that time, they buy it, and then they can sell it back to me at 68. And because I sold that put option, I have an obligation to fulfill. I have to buy the stock at $68. And that's fine. This is actually something that I do on purpose. This is me saying that I consider $68 to be a really nice buying price for Nike. So I'm accepting the possibility that the stock could drop below it. This is one of the important characteristics of the way that I use put selling is that I don't use this as a method to try to take advantage of momentum. This is literally just about identifying where I think the value, a good purchase price for the stock could be relative to where I think its value is, and what its current price action may be doing, and what's available in the options chain. And then if that's a good enough price, I sell that option, and then for me, I let that option play out to expiration. In the case of Nike, that means that this is a trade that doesn't expire until the 24th. So I still got 2 weeks to expiration on this. But if it continues to drop below 68, I can be assigned at any point up to the 24th. The truth is, these with American style options, most assignments don't happen until the day of expiration, assuming the stock is below it. And so that's why I let the option just play out through to expiration. If I get assigned, I get assigned, and that's fine. This is me saying 68 is a nice price, and I'm going to let the option expire and let the result be the result. Some people, and a lot of the people that we have in the Rebel Income community, and many of the people who are familiar with put selling, will use this a little bit more as a momentum method. And so, if they'll use the strike price that they've sold as a floor. In other words, it's kind of a signal point. If they think the stock is going to rally above that point in the very short term, that's when they'll sell the put option. They'll bring in the premium just like I did. But the difference is that instead of letting the result be the result, which is what I do, if the stock drops below 68, they're going to look for an opportunity to buy the option back quickly from the market and take the smallest loss possible. They're going to try to manage whatever that may be. They may have to pay a little bit more than what they brought in order to do that, but they will do that to minimize loss. The idea here is that they're betting on the momentum that the option is, or excuse me, that the stock is going to stay above the strike price. The time decay element of the put option is going to erode the value of that option enough that they are going to be able to buy it back for a fraction of the premium that they brought in at some point, or that the option is just simply going to expire worthless. So the difference for what I'm talking about is, instead of being willing to take an assignment, as I am, they're going to be looking for ways to manage the trade and avoid the assignment. There's not a right or wrong way to do this, and this is why, as we go into these, I'm going to show you. We're going to look at some different ways to manage these trades and to think about what current conditions mean for what you may decide to do. Okay, so with that in mind, that's the that's a little bit more detailed introduction, I guess, than I plan to do. Thank you for bearing with me on that. Let's go ahead and let's just start diving into the trades that we have on deck. The first one, just in terms of what's coming up for expiration, majority of these are 2 weeks in advance, so we will jump on those. Next week. Coming up next week is what I mean. But in the meantime, we do have a covered call on Bristol Myers that is worth taking a look at. This is a stock that I was assigned at the end of September at $46, and had an opportunity literally last week, just a few days later, to sell the $47 strike price and bring in $1.05 for a 9-day trade, a little over 2.2%. That's a nice trade, and this is like paying myself a dividend on the stock after an assignment. That's another reason that I really, really like to use these kinds of stocks for put selling. Is the opportunity to generate extra income after an assignment with a covered call. So I was assigned right around in here at 46. And then on the 1st, I had an opportunity to sell a call option Let me change my color. Let's see. 47 is the strike price for my call option. Now the stock briefly pushed above that point, but as we can see, it's been dropping back since then, and looks like it's increasing its downward momentum. So my purchase price is 46. I'm a little bit underwater on the trade right now. The reason I wanted to show you this is right here. This is a dividend declaration that was made right after I was assigned. The ex-dividend date was the 3rd. So I'm I've qualified for that dividend. I'm gonna receive that in my account, 62 cents per share. This is one of the big reasons that I don't avoid these assignments is the opportunity to take in these dividends. They don't always happen right away like this. And I certainly don't always hang on to a stock long enough to take in, multiple dividends at a time. I don't know how long I'm going to end up holding Bristol Myers, but the point is that when it comes to picking up the low hanging fruit of the market, dividends are one of the easiest ways to do it because too many growth investors just don't even think about dividends. They just want to look for growth, and so the dividend is not even a part of their calculus. Well, for me, I'm looking at this and saying I was assigned at $46, but I brought in $1.05 on my put sale. Bristol Myers is going to pay me another 62 cents on November 3rd just for owning my shares. To be clear, I sold one contract, so I own 100 shares now of Bristol Myers. So that's $1.67 in total income I've brought in so far on this stock. When I divide that by 46, that's 3.63% for a stock that I will have held for just a little bit over a month when the dividend payment is made. That's okay. That's a nice result already, even when you consider the fact that the stock is starting to approach about $2 below the price that I was assigned at. The $1.67 that we have here as well is also a number that I can use to think about cost basis. Oops, not divide. 46 minus, there we go, $1.67. So literally speaking, my cost basis is down around 44.33 when I factor in all of the income that I have that I've brought in first with the put sale, second with that was just with the covered call and the dividend. I didn't even factor in the premium from the put sale. That was 75 cents. So actually, I'm doing a lot better than I thought. All right, 75 plus $1.05 plus 62. There we go, $2.42. Okay, so let's give that a minus sign, plus 46. And my cost basis now is 43.58. That, again, that won't technically be true until November 3rd. But what this number does is this gives me an opportunity to think about price action a little bit differently. It doesn't mean that I dismiss the current momentum of the stock, which is clearly bearish, but with understanding that my cost basis is down somewhere a little bit below here, look, maybe a little bit in line with it, but 43.58. Starts to help me understand that even with all of this price movement, I don't have to panic. It is a time to start thinking about, what I want to do with the position. Do I need to Do I need to make any changes? Right now, I don't think so. But this is what this does mean for the current covered call is that in all likelihood, it's going to expire. Unless we see momentum really reverse between now and the end of business today. I don't expect so. It's so far we've just in the few 20 minutes of the trading day so far, bearish momentum appears to be picking up, not decelerating, and so looks like the stock is going to stay well below the $47 strike price that I sold. But I'm okay with that. That means that I'll have another opportunity at some point to sell another covered call. I'll keep an eye on 46, and when it's starting to approach 46 again, I'll look for another opportunity to sell another covered call. So that's Bristol Myers. As always, if any of you are in that working with this trade as well, let's see your numbers and let's compare them. This is it's part of the fun is to see when you guys do better than I am and compare notes and give out some ticks. All right. So let's go ahead and move on. In the meantime, that's Bristol Myers, and let's start talking about the stocks that are coming up in the next week. We've got a couple of put sales on CTRA and on Skyworks, and then a covered call on Schlumberger. But let's start with Coterra. Again, this is a stock. This is another one. All of these are stocks that I've been using quite a bit lately and have been in my watch list for some time. I like to use a lot of the same stocks. I don't really recycle. I certainly never don't clear out my watch list and start from scratch. The reason I don't is because good companies generally tend to stay good companies. They tend to be pretty predictable in terms of the way their management teams perform. And while the stocks while stock prices will certainly vary from high to low and back and forth, those price extremes simply create opportunities to keep placing functional trades. In the meantime, I have a pretty good sense for what these businesses are doing. And so I do like to add to my watch list when I can. And that's always an advantage when I find something new to follow. I think it was Barry last week gave me Occidental Petroleum, for example, which is a stock I've looked at before, but it hadn't crossed my desk in a while, so hadn't even thought about it. Brought that to my attention. Now it's in my watch list. So, but let's take a look here at Coterra. See what they're doing right now. Now, to be clear on this one, my assignment in Coterra came excuse me, I haven't been assigned the stock, but I sold the $24 strike price. Again, a week to expiration, and bringing in 55 cents. This was a 30-day trade at the time. So I brought in a little under 2.3%, sold 2 contracts this time, so 200 shares potentially that I could be forced to buy. Why did I sell more this time on Coterra rather than on Bristol Myers? That's a function of position sizing. And yes, there's the drum again. I want to try to make sure that every trade that I make, I'm trying to manage the position size in a practical way. There's a tendency when we're generating income the desire is to generate as much income as possible. We want to maximize the returns. So there's a temptation with put selling to sell as many contracts as we can. Whatever is allowed within the limits of the cash we have on hand or margin or a combination of both, there's a temptation to want to do that. That's dangerous. And I try to be a lot more conservative about that. Instead, I try to work from a perspective of what each trade means relative to the overall size of my portfolio. So in this case with Coterra selling the $24 strike price, this is my obligation point. I might have to buy the stock at $24. Next week, if the stock is below that point, and I'll have to buy 200 shares. So with that in mind, I can start to think about my math. 200 times 24 is $4,800. Now, I prefer to work on what is known as a cash secured basis with put selling whenever possible. That means that I want to be able to cover that potential obligation entirely with the cash in my account. I don't want to have to rely on margin, simply because I don't want to deal with margin interest or the other possible complications that come if a stock's momentum accelerates against the trade more than expected. That can create some difficulties that create some of the horror stories you hear about options trading and put selling in general. I want to avoid those, so I work on a cash secured basis. So $4,800 is my obligation. This is the amount of money that I have to keep in cash in my account throughout the duration of the trade in order to meet that potential obligation. That, as a percentage of the overall size of the account, oops, need to back up here, divide by, is only a little over 1.5%. Now, this is a very conservative position. My general recommendation is never to sell more contracts than would create a 5% of your total account position, if that makes sense. That would actually be a lot more than the 2 contracts I sold here. If I were to do 5% of my account, oops, sorry, 0.05 times, there we go, means I could sell up to $15,000 worth of contracts. That's literally speaking relative to what I've sold, that's possibly up to 6 contracts. And if you think about that at 55 cents per, that's $3.30, $330 rather than the 55 or $1.10, I should say, that I brought in by selling just the 2 contracts that I did. So I'm not going for maximum income here. And I'm doing that on purpose because I want to be very conservative. The maximum, in my opinion, should be no more than 5%. Depending on how you feel about market conditions, you may want to go more conservative. I've actually been trying to stay between 2 and 3% now for a couple of years. CTRA is an example of even going a little bit below that right now. Again, just because I want to continue to be able to place functional trades. I want to be able to continue to use the market to find these opportunities to own these attractive stocks at good prices. But the market is a little bit elevated and has been, continues to be. Here we go. And that's something that just makes me a little bit more nervous, a little bit cautious. We've seen just from April, here we are around 49.58 for the S&P 500. Now we're almost 2,000 points above that in what is this, about 6 months? That's very aggressive. That's exciting for growth investors. It makes me a little bit more. It doesn't mean that I'm not we haven't enjoyed some good trades here. It means that the longer this overall bull market continues, literally speaking, going all the way back to 2023 from a low around 34, more than doubled in value. 2020, late 2022, excuse me. Okay, it means that the market is pretty extended. Doesn't mean it couldn't continue to keep rallying, but we're a little bit. This is approaching once again a little bit of overvalued status, and so that tends to make me want to be a little bit more conservative about the sizes that I'm using for my individual trades. I'm not the kind of person who's ever going to get so freaked out about the market that I'm going to pull everything out and I'm going to go sit on cash and stuff it under my mattress. But I am going to become more cautious about the trades that I make. I'm going to be more selective about when I place a trade. Rule number one. And rule number two, my position sizing rules are going to become more conservative so that not to necessarily shield me from downside in those trades. I mean, if I own 200 shares of CTRA and it drops well below 24, even further below where it is now, then that's something I have to be willing to account for that possibility and decide if that is going to be a problem. The truth is that at 24, the stock is a great value. If it drops below that, it's an even better value. So I'm not entirely afraid of that. That's why I don't mind the idea of taking an assignment here next week if that happens. But you got to think about what that possibility is and make sure that your position sizing rules are built to help you manage the trade effectively. One of the members of our group, Carl, likes to talk about the sleep test. And I love this idea of the sleep test when it comes to position sizing. If you're ever looking at a stock and you're thinking about owning it, or you're thinking about the amount of exposure that trade would give you in the market, if that idea is going to keep you up at night, you're going to avoid sleep thinking about what is happening with this stock, then you either have too many shares or maybe you just need to avoid it altogether. More often than not, this kind of thing happens because people make too big a bet. They aren't thinking conservatively enough about their position sizing. So it doesn't totally shield you from risk or downside, but it does help you to manage some of the emotion when those stocks drop down to levels drop below the prices that you were assigned at, so that you can remain objective in your analysis and hopefully make better decisions about what to do with them. Okay, so with Coterra, it does look like right now, if price doesn't recover, this is interesting because it's really just in the last 3 days that the stock has dropped down below the 24 strike price that I sold. And this is a pretty solid mid-range of all of this chop that we have in this consolidation range from July till now. I have the top end around a little above 24.50, the low end around 23. So my potential assignment price here is right in between. Now, as I mentioned, I'm not afraid of taking that assignment, but what if your perspective is a little bit different? Doesn't mean that you're wrong. It doesn't mean that I'm more right or that you are. It just means that there's a little bit of a difference of opinion. And as I mentioned, this is going to be one of the things where if you prefer to take a more active approach to managing your trades, maybe you are in favor of the idea of rolling, for example. This is an example of a situation that might prompt you to think about managing loss. So here's next week's chain. Here is the $24 contract. This is the one that I'm working with. And here's the current asking price. Now remember, on this one, I brought in 55 cents on my put sale. Now that's still a good trade. But what this means, if perhaps you're not like me and you don't want to take the assignment, maybe you disagree with my analysis about the stock's consolidation range, and you think that maybe the risk of seeing the stock drop even drop below that range, go below 23 and maybe even further. Maybe if you want to avoid that possibility, again, this is not necessarily wrong. This is just a different perspective. If that is the preference, then buying this back might make more sense. It does mean absorbing a loss. So this was a credit. This would be a debit. So you'd have to be willing to absorb a loss of 50 cents on this. If I were to do this, this would mean $100 on the two contracts that I sold that I would need to do. However, buying it back and doing this would eliminate the potential obligation. Then the other $4,700 that I used to secure the trade, I can move on and I can redeploy that elsewhere. So this can be an effect if you are the type of trader that likes to manage your trades more actively. You're going to roll, and we'll expect we'll see some opportunities here to roll in favor as opposed to against, and show you why that is an advantage as opposed to trying to, in this case, manage the loss. In my case, I'm going to go ahead and I'm going to let this play out. This is not so far away from 24 that I'm worried. And even if it continues to drop below that point, I'm okay with buying it at 24. That'll just create some other opportunities, kind of like with Bristol Myers, to bring in some income from dividends and in all likelihood to sell covered calls. So Barry here, thank you for your comment. So we mentioned last week you were assigned last Friday at 24.50. Looked at potential calls on it this week, but didn't make sense without going so far out. Yeah. And sometimes that's going to be true, right? When you say so far out, Barry, I'm going to assume that you're talking about far out in terms of time. And that makes sense. If you look at, here's the bid and ask prices above 24.50, right? That's not great for 7 days. Here's 25. This is interesting. $1.65 ask, but zero on the bid. So there's probably nothing here. Very not a ton of open interest and no volume on this one. So it'd be hard to try to place that trade. You would certainly probably be somewhere closer to somewhere in the 30-cent range would be my guess. Again, here you go. Yeah. You've really got to start getting out here into a month or more, right? And so, yeah, if that's too far out, that makes sense. Gib, I like this comment. Thank you. You could roll up with the contracts and stay within your size guide. You're absolutely right. And here's another, I appreciate this, Gib, because what Gib is talking about is another approach to active management, right? So let's say I bought this back for $1.05. Okay. Then I'm going to have a 50-cent loss in that case. But if I still like Coterra, maybe I just go a little bit further out. And in this time, I go in the opposite direction. Instead of time, I try to think about possibly looking for something with time and price. So maybe here's 23. Again, not a ton of activity here, but you've got a bid at around 35 cents. That's not quite 1.5% for 3 weeks, but still, that's a possibility as well. And you're right. When it comes to my position sizing rules, I'm still going to be staying within that, right? 2 contracts at actually lowering my price is going to give me a little bit more flexibility. Not necessarily saying I'll sell more contracts, but it reduces the overall position size. It reduces that percentage and makes it a little bit easier to manage. So that's not horrible. Barry, yeah, I try not to go so far out that the stock has a chance to recover and blow through my strike price, right? Because we all know that happens sometimes, right? And so that is one of the risks. When you're selling a covered call, you're putting an absolute ceiling on how much potential profit you can bake into the trade. My covered call on Bristol Myers is a really, really good example. Even though that's going to expire today, the maximum gain that I put on that was at 47. So if something happened and all of a sudden the stock was at 50 or 55, it would not matter. I was going to sell the stock. I would sell the stock in that case at 47. Doesn't matter whatever the actual price is. So that's a great point. Barry, I have a $38 on call on Intel for next week. Had I known it was just going to keep climbing, I would have waited to get a little bit more capital gain. Yes, but there also is too is the question of what's good enough, right? And you can try to gaze into the crystal ball all you want, but when all is said and done, all any of us are doing is trying to make an educated guess. Yeah, I did say educated just now. Educated. We're just really trying to guess at what we think the stock is going to do. And when you see a stock going parabolic like Intel is right now, it's hard to try to predict. So really, for me, this is one of the things to keep in mind if you're going to be working with covered calls. Be aware that you're setting that ceiling and just decide that you're okay with it. It's the way it is. Sometimes this happens. It's the nature of the beast. We have to be willing to settle for what is good enough, not for what gives us the maximum possible result every single time around. So, okay. That is Coterra. Let's take a look at the next one in order, and that is Skyworks. Now, this is a stock that this put sale came last week. Oh, here we go, Barry. Thank you. FLUX is another one. You've held it forever. Really quick, I just got to, by way of disclaimer, got to say although I know I've heard of this company, I have not done any analysis on it, so I can't speak to the fundamental strength or value proposition or anything like that. This is all just for illustrative educational purposes, not a recommendation. Wow, look at that one. You've held it forever. It crashed. So recently I sold calls for $5 to get it off your plate. Yeah. And now it's at $6.75. And so you're selling right here, and you just got to be willing to say, okay, I can live with that and move on, right? It's not a bad thing. Getting called out of a covered call, even if the stock has shot way up above the price that you sold, should never be considered a bad thing. Again, we're just going for good enough. Let's not get greedy. There's a tendency when we in the stock market for people to think too much about maximum possible gains. Keep trying to shoot for the cocktail party story about the stock, the double bagger and the triple bagger that they nailed. I don't care about those. I don't go to cocktail parties. I don't need those stories. I just need good enough. Okay, let's look. Let's talk about Skyworks. You can see the stock has been tracing back. Now this trade, this is a stock that I traded. The put sale was on October 1st, so it was right here. Stock was right around 78 at the time. And that set up an opportunity to sell the $75 strike price, bring in $1.80, which is a nice trade, almost 2.5% return for a 2-week trade is nice. Yeah. Barry, have you changed your methodology since you got into Flux? So it'll be nice to get out either way. Yeah. Clear the deck, bring in whatever you can from that. And if it's a gain, that's awesome. If not, then I'm sorry. But yeah, clear the deck and reset. So, okay. So $1.80 on this one, as we just mentioned, the stock is tracing back a little bit. In fact, right now it is about $1.50 below the strike price that I sold. Again, I'm not afraid of this. When I sold the put option on this, this was me saying I'm willing to buy the stock at $75. 75 is actually a really, really nice price for Skyworks. It's also true to say that 73.50 is a better purchase price, but that's with the advantage of hindsight relative to October 1st. I didn't know that. What I knew was that 75 was a good price and it was offering a good trade. Okay, good, Barry. So your cost basis is around 50. You brought in 30 cents for the call for 4 contracts for each contract. Yeah. So $1.20, that's not bad. Yeah. So if you're getting out of it with a gain, yeah, that's good enough. That's good enough, right? Especially if it gives you some of that flexibility back. So I like it. Barry, thanks for sharing that. There you go. Give you a tick mark. All right. So let's take a look here at Skyworks and again, think about what this would mean in terms of if you don't want to try to let this play out to the end of next week. And I am. Right now, it looks a little bit scary. I'm a little bit underwater. Next week could be an entirely different story. It could be back above 75. It may be even further below 73.50 than it is today. I don't know yet. I can't see that. What I can see is what is going on now. So if you are not willing to let this trade play out and play through to the end of next week, the next question is, what if I want to buy it back? Well, there hasn't been any volume on this contract today, but there is plenty of open interest here. And for me, plenty of open interest is usually 100 contracts or above. If you can see at least that number, then usually that means that movement on these contracts, on these options, is usually not too big a problem, as long as you're working within reasonable price levels. Now, there's a pretty wide distance here between the bid and the asking price. The bid is only 80 cents. The ask is $3. Since we always sell at the bid price, buying the option back, if that's what you decided you wanted to do in this case, Barry need to lose that tick mark for being in the trade at all. Nah, I'm gonna give you the tick mark for finding a way to make some money out of it and clear out of it and free up your cash. So we'll call it good. Whether you want to call it luck or not, sometimes luck is okay. We'll take luck when we can get it. So this distance between the bid and ask prices means that I've got to try to fudge my numbers a little bit. If I did not want to let this play out all the way to expiration, then I need to think about how to buy it back, eliminate the obligation, and try to manage the loss, manage my overall exposure, I mean. And for perspective, let's keep in mind this $1.80. There you go. Started when it was trading around 10 and worked it for about 3 years. Fair enough. I'm still not going to take away the tick mark. Okay, let's go back here. So at $1.80 is the amount that I brought in, right? Now, if I don't want to fudge the numbers at all, and I just want to try to close out the obligation as quickly as possible, this was sell to open. That's how I got into the trade. If I wanted to get out, just to simply manage the potential loss as quickly as possible, then I could just go ahead and take this asking price. I could, just ignore the distance between these two and say, buy to close. Oops. Buy to, sorry for the bad spelling and bad handwriting. I'm doing this with a mouse. Buy to close at minus $3. That means that the net result here would be a negative $1.20. I only sold one contract in this case, though. So that would mean a $120 loss, just simply to avoid any additional downside. That is already better than the roughly $1.50 difference between 75 and where the stock is now. So that's not terrible from the standpoint of loss minimization. If you're going to trade more, if you're really more interested in trying to roll these trades and be active in your management, that's pretty useful. And whatever difference you can get between now or between $3 and maybe another potential buying to close price, maybe you put it in for $2.50. I don't know, $2.75. You can try to fudge with the numbers a little bit. Just remember that when you try to dictate the price more than what the market is doing, you usually need to be willing to wait and accept the possibility that maybe the market won't move to your price. If I simply took the $3 and I used that as my buy to close price, there's a really good chance that that would get taken and that the position would be closed at that point. If I try to make the market come to me a little bit more, there's a greater chance that maybe it won't. So you decide what your preference is and what you want to do there. Again, my normal method here, I'm not afraid of the stock at 73.50 where it is now, even though my assignment price is at 75. I'm not afraid of the stock if it continues to drop below that point even more. And it's picked up just a little bit of momentum just in the little bit of time we've been talking. So who knows? We'll see where this thing lands next week. But I don't avoid put sell assignments because these are, again, I look at, for me, put selling is not only about income generation, but I use it as an opportunity to buy companies that I like at what I consider to be good value prices. I like Skyworks Solutions at 75. There's really no other way to put it. And so I'm not afraid to buy it at that price, even if the stock is below that. My value analysis says that its value price is well above that based on what their business is doing. Okay. So that's Skyworks. That's really it for the put sales. We already talked about Nike, and let's wrap up. Talk about Schlumberger. This is a stock that I was assigned in the beginning of August at $35, and I've actually been able to work with this a little bit already. Here's a covered call in the end of August at 36 that expired, but I was able to bring in a little under 2% on that covered call. And this is what I love about covered calls. These are like, paying myself a dividend. And then we have the latest covered call, also with a $36 strike price, bringing in 70 cents. So just between both of these covered calls, 67 and 70, I brought in $1.37 per share against the $36 that I had to pay for the stock. So that's 3.8% since August. That's not terrible. That's also to say nothing of the dividend, which was 71 cents that I qualified for at the end of August, was paid out in September. So $1.37 plus 71 cents. There's 208 is the total income I've been able to generate, both from covered calls as well as just owning the stock and bringing in the dividend. Divide that by 36, and now I'm looking at a little under 6% in the little over 2 months that I've held the stock. That's not terrible. This is an overall nice result. If I want to annualize that in simple terms, I just take the fact I've held it for about 2 months in a year, divide that by a year, that's 6. If I do that 6 times, it's about a little under 35% return for the year. That's not a bad result. That's why just by itself, this is a good trade. Even though, remember again, with the covered call, I've set an absolute cap on what the maximum gain is going to be on the trade. With $36, I've sold the same price that I bought the stock at. Sorry if you heard footsteps. That was my dog. It just pushed the door open. I sold the same strike price that I bought the stock at, not because I was not trying to build in some capital gain, but I was working. The premium was more than attractive enough. As you can see, I've been able to generate a nice positive net result in the stock, even with things where they are now. So we'll see where this one lands. But Schlumberger right now is down a little bit below $33. So it looks like I'm going to hold the stock a little bit longer. We've got an earnings report coming up on the 17th of October. So that's coming up next week. On Friday, we'll see where this lands. And the stock should, as we can see, it's picking up a little bit of volatility. That's normal ahead of an earnings report. So we'll see what happens here. And the market could just as well pick it up and push it back up above 36, which is up in this range. I'm underwater on this, but again, it doesn't really bother me too much. So, okay. That's pretty much it for all of the trades for this week. I hope this has been useful. Try to get the door closed, but that's okay. All right. Thank you for your time, everybody. I do appreciate your participation. As always, Please, another request. I do want to try to expand the scope of the Rebel Income community as possible. That's why I'm making this live stream public. Please feel free to share this share this link when you get it with people that you know that might be interested in learning a little bit more about income generation and about the Rebel Income method specifically. And let's try to get this audience as big as we can, get as much participation going as possible. In the meantime, I hope you have a wonderful weekend. Thank you, everybody, for your time and for your participation. I appreciate all of your comments. And if you have any questions between now and next Friday, feel free to send me an email, rebelincomesystem@gmail.com, or reach out to me on Discord or on Substack. Thanks again. Talk to you later.